Before we jump into markets, let's quickly talk about the most fundamental action for trading companies, namely trading. We want to use this video to explain what a trade is and give a few examples for them. Furthermore, one might think that for any trade one person has to lose money and another one is profiting. But this is not really true, and we will explain a few key motivations for why people trade with another and why it can be mutually beneficial. Trades are a very simple concept that can be applied in many situations. A trade is the exchange of one thing for something else. For example, if you buy something in the supermarket, if you borrow a tool, or if you trade on financial markets. Before starting out, let's briefly consider the question, why do people even trade? For this, it is important to understand that the same product can have different valuations for different actors depending on the situation, and thus an exchange of the product can happen through a so-called trade. Note here that trades can and arguably should be mutually beneficial. Note that the overall market on which trades happen is not necessarily always zero-sum, but even if it is, trades can still benefit everyone. This is the case since different participants may have different incentives or utility profiles. Differences in risk aversion or a mismatch in information can lead to trading activity that is overall rational. All of these effects can cancel out the zero-sum effects that people often associate with financial markets. To better understand this, let's consider some real-world examples of mutually beneficial trades. For the first example, imagine you're out in the city and are very hungry, but unfortunately you do not have any food with you. However, there's a small shop owner that sells sandwiches for $5 a piece. In this situation, you potentially would much rather have the sandwich than $5 in your pocket to lessen your hunger. For the shop owner, on the other hand, the situation is reversed. They are not interested in keeping their supply of sandwiches, but would much rather exchange them for money. In other words, your $5 are currently worth a lower amount than the sandwich for you, and vice versa for the shop owner. Therefore, it makes complete sense that you two exchange these items. As a result, both of you are happier and better off than before the trade. Thus, the trade clearly was mutually beneficial. Hopefully this example demonstrates how different actors can evaluate the same product differently based on personal different perceptions of their utilities. To give an example for such a situation in real financial markets, think of two investors in company XYZ that has a big upcoming shareholder decision to vote on. Now imagine shareholder A owns 49% of the stock, while investor B only holds 2%. What would an additional share of 2% for the company be worth to these two actors? Although both agree on the worth of the company, the 2% shares from investor B are valued much more highly for investor A, since they could buy them to guarantee the majority and thereby deterministically influence the upcoming vote. Thus, shareholder A's utility for these shares is potentially much higher than that of shareholder B. Now for a second example, consider a medical insurance contract as a product. If you're familiar with the insurance business, you likely are aware that consumers typically pay more than the expected value of an insurance contract. In other words, people tend to overpay. However, it is not hard to imagine a situation where you as a family father or mother cannot afford the risk or variance that comes with life. In other words, it is completely rational for you to pay a premium for this peace of mind, as well as to reduce the risk of some incredibly high medical procedure which could put you and your family in financial ruin. On the other hand, the insurance firm can balance out this risk across lots of people and thus is happy taking on this risk. Therefore, trading some money for a suitable insurance contract can be a mutually beneficial trade. The goal of this example is to demonstrate how different risk profiles can motivate trades. To further motivate this in a financial market setting, note that banks oftentimes have government-mandated regulations as to how much risk they can carry and how this should be spread over certain asset classes. Thus, in certain cases, they might sell certain assets or buy insurance-like products to manage their risk and stay within their regulated limits. As an example, if you're a business and need to borrow $1 million to build a new production facility, that will work quite well and the bank will happily lend you money. If, however, you want to expand across multiple continents and require $1 billion, things become much more difficult. You would pose a large single point of failure to the bank, and small banks may not be willing to risk giving you that loan. Now that you hopefully understand that trading can be mutually beneficial and oftentimes can have rational motivations, it is also important to understand that different market participants can have different informational points of view. For example, imagine you believe that Apple will perform very well over the next few years and think it is currently undervalued at its current stock price. At the same time, there might be someone else currently wanting to sell Apple stock, for example because they want to use the money for something else. In that case, it is likely that there is a price where both of you are happy to trade with another. A further side effect of trades is that they can reveal information and increase the efficiency of the overall system. For instance, a person willing to buy a stock at a relatively higher price, since they believe the price will go up based on their analysis, indirectly incorporates this information into the price. Such factors can spread out among lots and lots of market participants, of which some are very informed and sophisticated. This can lead to more efficient markets where prices more accurately reflect all available information. A further example of how different actors might have different information is a strategy that was deployed in the real world by some big funds to gain extra data on oil-related products. What these funds did is use satellite imaging to check how full oil tanks in some of the world's biggest oil depots were to estimate the worldwide oil supply and thereby infer appropriate prices and make profits. In this case, other, less informed participants were likely happy to trade their oil-related products with these firms since they did not have the same knowledge as them and thus likely another valuation. This kind of data that not everyone has easy access to or used gets called alternative data. As a main takeaway, remember that trades are a universal concept that applies to many more areas than just financial products. Furthermore, think about why people trade with one another. The main reasons are that they have different usage or utility for something, they have different levels of risk, and also they base their models on different information.